Brief analysis and technical outlook, EURUSD, GBPUSD, and USDJPY. After Fed Chair Powell's latest comments at NABE on October 14, 2025, the market is almost discounting 50 BPS cumulative additional rate cuts after 25 BPS in September. Powell also indicated the end of QT officially by DEC 25. Fed Fund Future is now discounting above 90% probability of 25 BPS rate cut each on October 29 and December 11, 2025, for a repo rate of 3.75%, i.e., total 75 BPS rate cuts versus earlier estimate of 50 BPS cumulative rate cuts during September-December 25. Powell also indicated the end of QT by December 25 officially, but the Fed may continue its shedding of MBS and will replace it with USTs gradually as a longer-term balance sheet strategy. Although the overall impact is minimal, it may support lower U.S. bond yields, while mortgage rates may remain comparatively elevated for the next few years, as the Fed will buy additional USTs and allow full maturity of MBS, mortgage security bonds. Overall, the Fed may cut 50 BPs in Q4 versus 0 BPS by the ECB and 25 BPS by BOE. For overall 2025, the Fed may cut cumulative 75 BPS versus 100 BPS by the ECB and 100 BPS by BOE, while BOJ may hike by plus 25 BPS. Both the ECB and BOE may close the QT by December 25, in line with the Fed. Over the last few years, apart from BOJ, which has its own issues, most of the major global central banks follow the Fed in their monetary policies, which were largely in line. Even BOJ's YCC and exit jawboning policy is well anticipated. Thus, there were no major policy divergent surprises. Also, all major central banks now closely coordinate among themselves after the 2008 GFC, global financial crisis. Almost all of them are synchronizing monetary policies through known predefined policy instruments like rate actions, QE, and QT, affecting the demand side of the economy, not the supply side directly. Although officially, BOJ maintains the YCC, yield curve control policy, all major central banks unofficially do this indirectly through jawboning and policy expectations. Almost all of the major central banks are cognizant of the fact that they need a comparatively weaker LCU, local currency unit, to stay competitive in exports, but also considering the impact of potentially higher imported inflation. All of them try to keep a balanced monetary policy and maintain a real policy differential. In fact, the US is the biggest client for EU and UK exports. Thus, the ECB and BOE both intend to follow Fed policy with a focus on not too much strength in their LCUs, EUR, GBP, and JPY. Weaker LCUs are good for export to the heavy EU, UK, and Japan. But in the last year, since Trump's election prospect brightened, USD has been under pressure due to Trump trade war tantrum 2.0 and Trump's session US stagflation concern, despite the more hawkish stance of Fed than ECB and BOE. As a result, the US dollar index, DXY, slumped over 4%, SPX 500, EUR, and GBP gained. Overall, stimulus-savvy SPX 500 soared almost 18% for lower USD, positive for exports, hopes of Fed and Trump pivot, monetary and fiscal stimulus, and AI tech optimism despite Trump trade, tariff war, and other headwinds, which can potentially push the US economy into stagflation or even an all-out recession in 2026. Trump's unconventional, uncertain tariff, immigration, deregulation, income tax cuts, and other fiscal policies stimulus are affecting both the supply and demand sides of the US and even the global economy, directly or indirectly. Although Germany and some other EU states and even the UK are providing some fiscal stimulus in the form of higher infrastructure and defense spending, they are much less aggressive than the US. In the last year, German 10Y bond yields surged much more than the US, UK, and Japan, as Germany has launched a $500 fiscal stimulus package, mainly EV and HSR transport infra, to boost the economy amid Trump trade war tantrums. For this, Germany is taking public finance by issuing bonds, a rare phenomenon, and the bond yields surged. Looking ahead, as Trump's trade tariff policies are expected to get settled by DEC 25 without any major damage to the EU, UK, Japan, and also the US economy, all major central banks will be in cautious mode considering the likely inflationary impact on both sides of the Atlantic as well as the Pacific. Thus, there may not be any meaningful divergence of monetary policies between major global central banks, Fed, ECB, BOE, and BOJ. But Trump's policies may continue to affect Wall Street. Positional technical outlook, EURUSD, GBPUSD, and USDJPY. Looking at the chart, whatever may be the narrative, technically, EURUSD, CMP 120 700, has to sustain above 1.16500 for any rebound to 1.17100 to 1.17600 and further to 1.18300 and 1.19500. Otherwise, sustaining below 1.16200, it may further fall to 1.13800 to 1.15300 and further 1.14400 to 1.800 in the coming days. Similarly, GBPUSD, CMP 134,000, now has to sustain above 1.34300 for a rebound to 1.34800 to 1.35300 and further to 1.36300 to 1.38000. Otherwise, sustaining below 1.34100, GBPUSD may further fall to 1.33500 to 1.33000 and further to 1.32000 to 1.31000 in the coming days. Similarly, USDJPY, 151.80, now has to sustain above 152.50 for a further rally to 153, so to 153.50, and only sustaining above that may further surge to 157 ASO to 159 ounce and 160 miles to 161.85. Otherwise, sustaining below 152 ounce, USDJPY may further fall to 150.50 to 149 SIR and 148 to 146.75 to 145.50 in the coming days. Bottom line. Overall, the USD trajectory will depend on the Fed's and Trump's near-term stance and its effect on the real economy.